Hi, hello.
Hello?
Hello. Hi, Graham. Hi, how are you?
Yeah, I'm good, thank you. How are you?
I'm good. Awesome. Good to hear from you.
Finally
Long time.
back.
Hi,
Hi, Natalie.
Hello, hi Graham.
Hello, how you doing?
Yeah, I'm fine. How have you been?
Yeah, all right. I'm just a bit behind with this, so yeah, I'm gonna start catching up now, which is good, I think.
No worries. You have time. You have time. You're fine.
Yes, yeah.
Hi, Hannah. Hello.
Hello, good morning.
Good morning. Good morning. How are you?
I'm good, thank you. How are you?
I'm well, thank you. I'm well. Yes, I'm well. Good stuff. Good to see you. Oh, 1 second. Yes, I think Dudley might be now in. Hi, Dudley. Can you hear me?
Annoying. Yeah, I can hear you.
Good morning. Good morning. How are you?
Not too bad, thank you, yourself.
I'm well, thank you. I'm very well, thank you. I'm very well, given the very things are well. I don't know. I guess we all like to look at the glass half full. Things are looking up. The it's sunny. That's the first thing, and hopefully we'll start having some idea of when we can start going out again properly,
Yeah,
clearly.
that'd be nice.
That'd be nice. Cool, great stuff. Hope you've had a good week. Let me just I sent you, yes, so I sent you some slides that we're going to be working through this morning. I hope you received those. They're really a copy of the text, really. But I just kind of, oh yes, James is coming in now, and I've also sent you a PDF version of the text as well. But I think I think the exam kit, I think the PDF exam kit is wrong. I just noticed, but I think the text is fine. So I'll need to get the right text, the right PDF from Kaplan. Hi, James.
Hello.
How are you? You're right.
I'm good, thank you. How are you?
I'm well, thank you. I'm well, thank you. Cool, great stuff. So let's dive right in. Two things, Natalie. I've just sent you. I've only just I marked them this morning, so I've sent you feedback on your questions. So you should see. You should be seeing some feedback from. You should see in your box question 152 and 153 in your mailbox, and the good answers. Technically, there's good improvement. Very good. And that's the thing about this subject. Actually, it's not that when you look at the question you think it's difficult. It's just that it's just getting technical, or just using the language that's most I mean, you could say the same thing using normal speak, but it's just using sort of that sort of technical language and just sort of picking up the style of what they want. So when you find a risk, whenever you find an audit risk, what you want to do is first you want to use. I know you have some problems with Word, but what you want to do is whenever you answer any of those questions, as you start answering them, just answer them. You'll probably be answering it correctly, but when you now review it, you'll see, okay, I actually see what they want here, in that if they say, oh, read a scenario and you have some audit risks, and what your responses, which are some of the sorts of things we're going to be looking at today, or the beginning of that, although you can still come up with some relevant responses anyway. And when you find a risk, typically when you're literally just highlighting what that problem was and talking about what the consequence is, and the consequence should always include overstatement or understatement, and you've satisfied that. So just to kind of show you, with those questions, any question that asks you, oh, you say, oh, for identify 8 audit risks and the responses, 16 marks. So of course, there's 2 marks for each risk, and 1 mark for the risk, identifying the risk, and 1 mark for identifying the response. But it's actually half a mark for actually identifying the risk, and it's actually half a mark for stating the consequence of that risk. So that's how you actually get the full mark there. So just highlighting what the risk itself on its own will just get you half the mark. And then you need to sort of say, and therefore this means there's going to be an understatement, or if you like, and this is the consequence, that's the full mark. Then you go and talk about the response, which is another mark. So that's kind of the skill. So this is why it's funny, people say, oh, I came out and I thought, oh, I thought I did better. They asked me for this, but I've not scored as much as I can. So it's just always remembering to almost state the obvious. Okay, let's begin. I will try and not overwhelm you with. It does feel like there's a lot of PowerPoint, but I'm going to talk through it slowly. I'll spend today and, if you like, next Friday, looking still more at audit evidence and looking at different examples. But hopefully, we should see. Get a good grasp of what audit evidence is really about. Dudley asked me a question 2 weeks ago. What I will do, I think by the time I kind of go through this elementary overview of audit evidence, I'll start to kind of show you what an audit file actually looks like. And so you can sort of see how this is applied. But this just doing this and doing the questions starts to give you the right, again, like I say, the language for talking about audit risks, talking about fraud, talking about audit procedures, and you start getting a good buildup of that. So let's go to the, where am I? Here we are. Let me just start from the beginning. Here we are. Oops, sorry. Let me just share my screen. Cool, great stuff. So hopefully you can see my screen of PowerPoints. And again, like I say, don't be overwhelmed with the number of PowerPoints. There's just a lot of topics, a lot of things to talk about. 1 second, let me just go right there to the beginning. And I'll just take it slowly and try and give as many examples as I'm going. So I think it's chapter 6, maybe chapter 7, but we're now on evidence. So we've talked a lot about planning, and again, like I say, a lot of this is what you would expect. We're only just adding technical language to it. If you're going to do any job, any engagement of any type, whatever it is, I'll go as far as saying, even as far as medicine, if you're going to carry out an operation, whatever it is, you would spend some time trying to understand the symptoms of the patient, understand the needs of the client, know what exactly you're going to do. These classic medical jokes about someone needing their heart operation and their kidney gets taken out. I mean, there is no difference in this need to have clear understanding. We're just saying the same thing. We're just being technical from an audit point of view, and knowing what risks to be aware of. Many patients, right? I suppose in the medical field will have sort of underlying conditions and sort of know what to take into consideration as you go, or know what the most serious risk areas are. So you're kind of assessing the client for risks, assessing the patients for risks. And that's the kind of thing we're doing here, really. So and that was what planning was really about, spending that time. So you wouldn't start this, if your audit is on the 31st of December, you're talking about planning in September, right? Maybe in in August, to sort of gain an understanding of where are the most critical risk areas, if you like. Because again, because of the nature of our work, we cannot look at every single transaction. We just can't. Unless, again, like I say, it's a small business. And the reason why a lot of judgment, and what I want to try and get you to think about, we talked about things like materiality and knowing what percentage should I test. Well, here's the thing. If you go into a certain business, for example, if you go into a jeweler's and they only have, let's say in their inventory, 10 pieces of gold, so to speak, well, you have time. You can look at all of them. So, yes, I've said that we sample, and yes, I've said that we don't look at everything. But again, you can see where this question of judgment is. I mean, you walk into an organization and they have 10 lines of inventory, and one of these lines, all the stock there is above, say, I don't know, 100,000, and all the other 9 lines are, say, £1 to £10 each, for example. Judgment tells you straight away that I can almost technically not ignore those 9 lines. So you can see that even after everything I'm saying about, oh, we need this to be a certain percentage, materiality is very much about professional judgment. Where is the risk? What is likely to be overstated when it should be at a certain value? So you can see that audit allows you escape as long as you're willing to just sort of look at the situation and think, well, where's the risk? Where are the items here that are value, that have the potential to be misstated? You know, not just it said test 10 items from every line, so I'm going to test 10 items from these £1 items, and 10 items, and then test 10 items from the 100. No, I'm going to test one item from all these £1 items and test 15 items from this. So it's you as that auditor make that judgment as to where you're going to spend that time. Okay, great. And that's kind of where that planning kind of approach comes in, and looking at controls. We talked a lot about this. As you would expect in any situation, if you can go into a place and you can rely on the controls, you're more likely to do as little substantive actual testing, if you like, as possible. Right? Okay, great. Let's jump into this. Okay, audit evidence. Again, like I say, not too bothered if I finish the 135 slides, 120 slides. That's great. If I don't, but I just want you to kind of take your time and just engage and see what, and highlight the key points. So on your own screens, I will highlight as well. Try and highlight the big words that we're talking about, and you see that this language is what I'll kind of highlight the language you want to use in your exams when you're answering questions. And I mean, I'm only referring to, you all know each other now. I'm only referring to Natalie because at least she submitted some work, and I'm beginning to see some use of that language. And that's where the examiner's he's marking on. Audit examiners are actually very lazy because there isn't much it's the same thing every time. They're just looking for the words. They're like, oh, yeah, that's the word. Tick, books, next. You see what I mean? So it's not like strategic work. It's not strategic thinking per se. It's just, well, we're just testing. Okay, great. So the two big words with all of this, with evidence, right? With any evidence, yes, I guess it just kind of naturally, again, like I say, it doesn't matter what field we're dealing with, is that evidence has to be two things. Evidence has to be sufficient, if you like, and evidence has to be, technically, the term would be appropriate. Now, you could use other words for this. You can use relevant, you can use reliable, you can use current, you can use useful for that time, if you like, timely. You can use what you like, but the key point is that appropriateness means suitable for what it is you're doing. So if I'm testing inventory, I don't look at trade receivables. If I'm looking at inventory in this year, I don't look at inventory from the previous year. So you can almost naturally understand what it means for evidence to be sufficient and appropriate. Now, this question of sufficiency, of course, again, depends to a certain extent on the controls. If they're good controls in place, Dudley might think, okay, I'll only look at 5 items. Graham might think I'll look at 10 items. But both of them are making these decisions based on how confident they are with the controls in place. And they'll say, listen, if one goes through okay, well, and I've observed that happening, and I've done the walkthrough myself, and I can see things are working in this system, then I can be assured that the rest. Again, my problem whenever I try and teach audit is that if I talk about too many examples, I don't even get through my slides. We could go through wages. If the question is, well, I want to know whether or not the wage figure is what it should be, say 1 million, well, you want to look at the number of people. You want to look at a certain number of employees. The question here is, if you look at the system and you see that the way they're using computerized systems, the FD signs off and matches the payroll list to the actual bank accounts, and you can see that HR do a thorough job of removing leavers and getting joiners on, and you can see the systems, and you actually test it for a new joiner up to when they get paid, and then leaver. You probably won't test all the employees. You probably test 5 or 6 or whatever. It doesn't matter. But the key point is that you can determine it. It's a matter of judgment as well. So hopefully when you see these questions, you can just almost naturally click in that, well, this is what I would do. But ultimately, we want to highlight the fact that sufficiency is important, and this is to do with quantity, and evidence being appropriate relates to the quality and the reliability of that evidence. Now, let me just minimize this. So again, like I said, sufficiency relates to the quantity of the evidence, and how appropriate that evidence relates to the quality and the reliability of the evidence. Again, this is just highlighting what I'm saying, so I'm just going to I won't spend too much time repeating myself. But the key point here is that you as the auditor need to be satisfied there is enough evidence to support your conclusion. And we could be talking about whatever it is. It could be a disclosure, if you like, a disclosure regarding, say, a liability, a potential liability. We just need to know that there is sufficient, if you like, and that's very much a matter of professional judgment. So in determining whether or not you have enough evidence, like I said here, the big question I talked about earlier on was this question of controls. What are the controls in place that will determine, if you like, the issue? And of course the materiality. So again, if this is a highly sensitive area that we consider to be material, if you like, and definition of materiality from our previous lectures, where is really the definition of materiality is that would the omission of this item mislead the user of the accounts, right? To what extent would the omission of this item, if you like, mislead? So £1, £2, no. Inventory, you've written inventory is 50 million. I think it should be 50 million and 1 pence. It's not material, if you like. Is the difference large enough, if you like, or the potential difference large enough for us to question and say no? So depending on that, if I can see if we see there's a risk area here, I'm going to carry out more evidence and look for more information, even though your systems are good. It's about balance, isn't it? And really the risk of material misstatement. So the risk of material misstatement, we know, if you like, depends very much on the controls, on the systems in place, on the nature of the item. It's just sort of those things. Again, like I say, the controls tests, of course, are important. The size of the population being tested, your knowledge and experience of the business. So again, like all relationships, the more and more you are, you understand the business and you've been working with the client, that will tell us how much, like any relationship, how much of that evidence you actually need. So typically, in terms of audit evidence, there are a number of things, of course, that we need to think about. The size, if you like, of these samples selected, to what extent can we rely on the evidence? And these are the first two things: the size of the sample and the reliability of the evidence involved. Again, very much all based, fundamental to all of this is controls. Good controls will fundamentally determine the size of how many items you want to look at. I'm just giving you the example of wages. I mean, we could talk about, let's talk about revenue, for example. We have sales invoices. Maybe an organization has maybe 1 million actual transactions, 1 million different transactions. We'll talk later on about what we're looking for, but you won't get the chance to look at 1 million of those actual invoices, sales invoices. You're not. You have to decide, how many am I going to look at? Good controls, you look at fewer, so you see where I'm going. So let's, for example, look at the audit of a bank balance. So kind of coming back to what Dudley was asking for, we will look at this, but let's just look at bank balance. Has always been is probably the easiest balance on the statement of financial position to audit. And so typically you and I know that you will have a bank balance, for example, say showing 1 million on your actual if you like, statement of financial position. So bank, and of course you and I know that this many organizations can have several bank accounts in the organization, not just the one account. For whatever reason, they can have bank accounts A, B, C, and D. That's fine. Yeah, so this is on their statement of financial position. So of course, and all this might come to 1 million. Now, I want to confirm this figure of 1 million. So I'm going to need two parts to this information. I mean, although to be fair, the more we talked about this last week, the more the more digital we're getting, or the more electronic we're getting. Although you sort of corrected me last week or 2 weeks ago, saying, well, Owen, we still do a bit of bank rec work. Typically, what we try and do, what we have to do to confirm this figure in our statement of financial position, technically in your ledger, if you like, is to speak to the bank. Or when I say speak to the bank, confirm directly with the bank. So this starts to give you this question of appropriate. We'll talk about this question of being appropriate. That external evidence, we'll see that in a second. It's better external evidence confirming figure is much healthier or stronger, probably the best third-party confirmation of evidence, is the best form of evidence. So the bank could come back and say to us, actually, what's in the at the year end, it's actually, for example, I don't know, 1.5 million or 0.5 million, something along those lines, or it might match or whatever it is. But the key point is we know the reason why there's a difference between the actual money in the bank and what your cash book is saying, if you like. But at least we begin to start off our evidence there. Now, the second thing is this question of completeness. Like I said here, on its own, this is good, great, thank you very much. We have a starting point, but we know there are other things, if you like, that will lead to this completeness and this question of timing differences. We've talked, you know this, at the back of your hands. We need to see the bank reconciliation, and then we need to review those bank reconciliations. I mean, I say review the bank reconciliations, review the bank reconciliations, and look at the, and literally look post year end to see whether or not those checks have come out and come in. And that's sufficient, if you like. So not just seeing what the bank have said it to be. So technically, auditors would typically start off their bank reconciliation for balance as per bank, if you like, and then work to the cash book. Although I remember teaching this a lot, and I never remember which one. Textbooks are always changing, but I remember there was a time of textbook that always wanted you to start off with balance as per cash book. That's fine, doesn't really matter which way actually. But you can see here, we're saying that I trust this third-party evidence of the bank. I want to see if it reconciles to what you're saying, if you like. And then I will put through all the unpaid or whatever, outstanding lodgements, blah, 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 and then arrive at your figure. So those are the pieces of evidence you would need, if you like, to confirm, if you like, whether or not the figure in the bank is what it is. So again, I highlight here that you should perform a bank rec. That's great. And in combination, two pieces of evidence. So, I mean, in an exam question, you can get a very straightforward, I mean, this is wonderful. Typically, you might get this for 5 marks if this kind of thing comes out. Straight question, how do we confirm, if you like, the balance in the bank? And this is exactly what you would do. You would obtain third-party evidence from literally right to the bank, and the bank will send the bank itself. So it's not the client. I know you're going to think, well, Oyen, couldn't I just go to the client and get the bank statements from the client? Apparently, people aren't that no longer trustworthy. I've never seen it. I've never seen clients sort of do things to bank accounts, like, I don't know, Photoshop them. I've never seen it. That is the height of fraud, and I think it's too much of a risk, and no organization would be that. Well, no, impossible. I mean, I'm yet to see it. Who knows? I might be surprised. But we write directly to the bank, who send us the bank statements, and then we can confirm from there. It's a bit called a bank letter, and it just works, and it gets sent to you. So. Okay, great, and that was sufficiency. So typically that's sufficient. The bank rec and the bank letter are sufficient pieces of evidence. I mean, they're reliable, they are relevant, of course they are. And that's where we come to next. We'll talk about this question of appropriate evidence. So appropriate evidence typically has to be reliable, and we'll talk about the definition of this question of reliability. I guess with the question of reliable is, who can I trust, if you like. Again, natural language, we're just being technical for our own purposes. And who can I trust? And I don't know, I mean, at least I know Natalie has kids. In my house, we must have, I've said it several times, we must have a tooth fairy or a fairy who comes in. I'll see water on the floor. I'll see a place that was totally organized, completely disorganized. And I'll ask, who did this? And I have 2 little people in my house who tell me, no, not me. No, not me. So I always say, well, there must be a fairy, because I don't understand how the place can get, I don't know who to trust anymore in my house. But the key point is that we're always looking for trustworthy and dependable sources. Who can I trust? So typically, sometimes the thing about this type of knowledge is hopefully you will see that, and as Natalie would have discovered as she was doing questions, that they always ask you, like, before you start the actual question, like a 3-marker or a 4-marker on just knowledge, just general knowledge, you know, little things like that, 4 or 5 marks. Again, it's not the end of the world. Have a good stab. You might remember. It's just knowledge. There's enough knowledge you're trying to remember anyway. If you get 2, and then jump into the key big question about the risks or whatever it is. These are the types of questions you can get for knowledge. When would you consider knowledge to be kind of reliable and relevant? Well, again, if it's obtained fundamentally from an independent external source, which is why we're even there, if you like, right? I mean, again, one could go on. This is the problem with audit, or the good thing or interesting thing about audit. You could carry on talking about it. Shareholders have come to us because we are external. They could ask the directors to prepare the accounts and just look at them and trust them and ask their own internal audit to do the audit. But no, they want an external third party to come in. Anyway, key point here is that yes, I mean, generated internally, but subject to effective control. So you can see here that typically we have to work with what we can, right? We have to work with what we can. And typically when you go in as the auditor, actually directly get the work yourself. So it doesn't really matter what we're talking about here. It could be trying to document a system to see if the controls are working, literally to understand what happens from order to paying, if you like, from registering or putting on a client on your wages list to paying them. It doesn't really matter, from goods arriving to goods leaving in the inventory. But the key point is you yourself, you spend the time documenting the process, or you've spent your time doing the testing. Then we can rely on that piece of evidence, if you like. And of course, paper form or documentary form, and in its original form, again, because people do Photoshop and change things. So you want the original. So typically we will never ask, we won't accept a scan, and we say, unless you had to, but you want to see the original documentation. Doesn't matter who it's from. Again, we could be talking about a letter from the lawyers, we could be talking about invoices, doesn't matter. We want the original invoice sent by the client. Although there's a lot of things happening via the internet now, people are sending invoices via the internet. So if you like, this is still old text, isn't it? And we have to adapt, of course, to new technology. And I guess the question here is that, so you can see the key point here, and I know you can imagine here, broadly speaking, the more reliable the evidence is, well, the less of it I need. I don't need. Reliability is so key. It's important. If you can trust the person who's saying it, and if they say, I trust the controls, I trust the system, that's fine, if you like. And it's never really the case. So key point here is, the converse isn't true, but this isn't the kind of thing you get tested. It's just your understanding, right? That if evidence is unreliable, if you just can't trust it, it doesn't matter how much of it you're given. You can't trust the evidence. Let's go into inventory, for example. If you look at a scenario and you see that, yes, and I want to focus. I'll focus a bit because Natalie wrote a bit about it, but I'll focus a lot on work in progress because that's always a very popular thing that you want to. I'll talk about it a lot. So whenever you're writing about work in progress, because inventory is the most important, I think inventory is still probably the most important balance ever. And inventory just covers this so much, right from stock take to actual valuation. If work in progress, because inventory also has components of raw materials, work in progress, and finished goods. So let's talk about work in progress, because that's usually where we have direct materials partially used, maybe in different percentages. We have labor partially used in different percentages, and we have production overheads that have, and remember, production overheads are done via an overhead absorption rate. So someone's come to some judgment, if you like, as to how I would allocate the overheads into these units that we're making. This is all requiring judgment. Now, if for some reason you cannot trust the person who has decided this, or you did a few and you did one or two, and you already had problems with the way general overheads were allocated, or how labor was allocated, it doesn't matter how much of it they give it to you. Totally irrelevant. You can't trust it. Right, and that's the key point. That's the key point there. Relevance, again, relevance really here is to, you see, because, and I think the stock take is probably that I could talk about relevance out of context, but let me just focus on an example first. Now, again, I want to use inventory so you can start forming in your minds clearly what's going on here. The only reason why you attend a stock take for any organization, the only reason is to understand the controls. You want to, because you see, this is your only evidence, so to speak, unless you attend once a month. They're called periodical inventories, where many organizations will, because they have a lot of stock, they'll count particular lines, maybe once a month. So they'll count line A in January, count line B in February, and you can attend those. But most organizations will count all their inventory on a particular day. You're not attending that day to count. First of all, the only reason you're attending, like I say, is to look at the controls, because number one, you cannot count all the inventory. So you need to rely on the controls over the counting. You need to be sure they have good controls over the counting. You now replace reliance on the controls, and then from there you say, well, the controls are good. I can see that that they have, that when they count this section, they tie it up, so you don't have the risk of someone recounting again, if you like, and they only count it once. And that you have two people counting. We'll come when we look at inventory and collecting inventory for evidence, we'll look at that. But the key point is that you're attending because of controls on that day, because that's the year end as well. So attending this inventory count the day before, the day after, 2 days later isn't efficient, because we were talking about inventory on that particular day. So it really has to be relevant. Giving me the stock take on the 2nd of January doesn't really help me. I'll have to adjust for the 2 days, 1st of Jan and 2nd of Jan. And that has its own problems. So I want to avoid all of that, and I want to know how much inventory, because I want to know that no more inventory is coming in, nothing is going out, what was happening really at the year end. And that's exactly why relevance is really important to attend on that stock day. We'll talk about valuation and things like that later on, but those are the really for controls. I mean, we test other things on that day as well, but the key point is that it's very much about the controls. Okay, great. So let's talk about this a little bit, because inventory, like I say, so attendance at inventory provides us a good example of the relevance of procedures. So during counting, so this is the first thing I want to highlight. This is the first time I'm talking about this. So just kind of work with me and really pick it up. It's not tricky. It's just that people don't see it the first time. During counting, the auditor considers the relationship between inventory records and, again, what you have on paper. So that's your inventory records. So whatever you have, everything, and that goes onto your statement of financial position, that closing total figure, right? And of course, your cost of sales. There's nothing wrong with highlighting, when I say consequence, highlighting the fact that inventory probably, I'm sure, is the only thing that applies or that appears on the statement of financial position and the statement of profit and loss. And overstating it improves your profits and improves your current asset ratio. So that's part of the consequence of why those are the kinds of things you're talking about, leading to the overstatement of profit and the overstatement of the current ratio, or the overstatement of current assets, overstatement of net assets. Be very fluid and happy to write about it. That's what the examiner wants to clearly see, your link between audit, accounting, and to a certain extent financial reporting. Okay, and this relationship between inventory records and physical inventories as follows. Now, this is the first thing I want to highlight. Identifying items of physical. So here is my list. This is one test you will always do at your stock take. Here is my paper. My paper says this, and here are my actual physical. This is the actual inventory itself, and with the different rows. Let's just put that row A, row B, row C, row D. Okay, great. So identifying items of physical inventory and tracing them to the inventory records. Now, let me just finish this. It says to confirm the completeness of the accounting records, and identifying items on the inventory records and tracing them to physical inventories to confirm the existence. Okay, great. So I'm going to come later on. If you peek down my slides, you'll see I talk about these words. I don't want to use the term yet, but let's just say I'm trying to prove two things, right? I'll talk about them again. But right now I'm trying to, and I think, at least again, just referencing Natalie's work, she talks a lot about completeness. So here's the thing. It's easy to sort of say, if you're doing a stock take, if you want to know if something exists, if you want to know if any item exists, it doesn't matter what it is, even a non-current asset. You go, you look at the item, you look at it. So you look at the item. So you look in row A. So they say they have they're selling off some gold. Let's say gold carat 1. It's in their inventory. You look at it. Oh, it does exist. I mean, what happened was that you saw it here, gold carat 1. So you want to see if they actually exist. So you go here and you look at it. You see, oh, listen, I've seen it. And you now sort of say, oh, I can use your eyes, and you can say, I can map from what I see, if you like, to the page, if you like. So identifying items of physical, sorry, one sec. Here we are, identifying items and tracing them to confirm the inventory record. So you've seen it on the page. You've seen, well, that you're saying you have this gold carat, and I'm going to come here and I'm going to look at it. So existence is about us saying everything you've put on here, I can see it I can actually look at it. It physically exists. Again, like I say, the reason I'm going to the stock take is because you won't get a chance to look at absolutely every single thing on their stock list. But if they have good controls, you can trust that what they say here actually exists. And so existence tends to be an easy one for people to be happy with. I've gone along and I've checked and it exists. Now, here's the problem though. The question here is that an organization might have, I'm just going to call this another room. They might have other inventory, if you like, that are sitting here, if you like, and they haven't recognized this inventory on the page. They've left it off the page. They've left it. It's not on this page. It's just not on here. It's not on there. It's just not on there at all. But the inventory exists. Now, typically, again, like I say, with audit, hopefully you see the issue here. Typically, the only reason why you don't show things on your statement of financial position is because the reason why you're leaving things off is either because they're liabilities. You expect people to typically, we don't really test for completeness for assets, because typically we usually expect people to show all their assets. That's the nature of humans, to show off all their assets. But inventory is peculiar because, first of all, we might have inventory that's broken down. We have inventory that we need to write off. People are always hiding things. So what we also do is we also go along and we actually look. So we kind of ignore the page and we ask the question, you see this item here? Is it on the page? Because I want to make sure that that this page is complete and has everything that should be on there. Now, I don't know why this client is hiding this inventory or not showing it for whatever reason. Maybe the inventory is obsolete and they don't want to declare it. Maybe they want to sell it off later. Maybe it's hidden. Nobody knows. Nobody's quite sure. But the key point, I mean, when I say nobody's quite sure, you don't know the minds of individuals who run these organizations sometimes. What we want to do is we want to make sure that absolutely everything in all the, so you notice people say things like when you're doing a stock take, you should go around and you should look in corners and you should look for inventory that's been covered for any reason and ask this physical inventory, is it on the page? And so this allows us to test, if you like, for completeness. Now, again, this is inventory, so we typically expect the problem to be with existence. We typically expect the problem to be that you're saying you have this gold carat thing here worth 10 million, but when I come to your stockroom, I can't find it. So typically the problem with inventory is existence, not usually completeness, but we test for both, if you like. So that's kind of the first thing I wanted to highlight with this question of relevance, if you like, because we're looking for these things about, like what I was saying here, completeness and existence. Right. So again, like I highlight here, this is the word I was going to talk about. Yes, the procedures are perhaps similar because we're looking for something, but we are testing different assertions, and I'll come back. This is our big session, so to speak, today. This question of assertions. Okay, great. So here's the thing. All right, I need to come to I need a guide. I need a structure to collect my evidence, first of all, and to kind of come to some kind of conclusion as to whether or not the accounts are free of material statement. I can't just run in there and just willy-nilly check up on things. I need a guide. I need a structure to actually do this. And so this comes from the structure starts off with the client. The client is asserting, and this is a word I want to almost highlight. The client is making certain assertions. The client is asserting that here's my income statement. The client is asserting that my non-current assets, he's saying, he's declaring legally that my non-current assets are 10 million. But he's not just saying my non-current assets are 10 million. He's saying a number of things about that 10 million. This is important. That's what assertions are. He's making certain assertions regarding that figure. It isn't just about valuation, the 10 million. There are other things he's actually saying, if you like, that they don't naturally come to thinking. You're thinking, well, that's obvious, but he's actually making those assertions. Valuation is the easiest that comes to mind. I've just talked about two a second ago: existence and completeness. Right? So that's what we're going to be looking at next as we go. So in the process of collecting evidence is me testing those assertions. So I'm basically collecting evidence. So you can see we have structure so that it's not random. Audit evidence is fundamentally about testing these assertions that the client has made about their figures on their statement of financial position and on their income statement. Okay, great. So again, like I say, I don't just randomly do this with broad objectives. No, I have to be ordered, if you like, and I have to go through a series of detailed tests with specific testing relating to certain areas on the financial statements. So again, lots to write about, but let's just go through. So for example, the reason why I have to be so careful about this is, again, that's just focusing on inventory here, is there's many ways inventory could be misstated. So in terms of these assertions, how these assertions arise. So first of all, it is possible that inventory could be missed out. Could be missed out of inventory. So like I said, this question of completeness, if you like, it's obvious that I can have items from the next accounting period, if you like, that could have been accidentally included. That's a matter of completeness as well. These are items that shouldn't be in there that are in there. It might be that, if you like, items of value have not been valued at the lower of cost and net realizable value. That's valuation. Again, valuation, if you like, and you have all these type of things. Of course, even the question of existence. So and it's possible that purchase costs may not be recorded accurately. So there's a question of accuracy. A big one I always talk about inventory is this, again, like I say, raw materials, WIP, and finished goods. Right now, these are three different areas within inventory. So classification is important, if you like, between these three areas, and even between those kind of what's making up WIP. So each of these could lead into to material misstatement. So what I'm testing for really is I'm really looking, if you like, at this issue of assertion. So audit evidence is always all about testing these assertions. Okay, great. So again, like I say, auditors have to perform a range of tests on the significant classes of transactions, account balances, and disclosures to be reasonably sure that they are not misstated. And these tests focus on what we know as financial assertions. So let's begin. So the first assertion is that the transaction occurred. Now, what you can see me do here is I highlight the financial statement that this happens in. I think I might have talked about it before, but for something to occur, it happens. It's a flow. I mean, of course, typically, it's not that occurrence doesn't happen in the statement of financial position. So, for example, you could have bought a new non-current asset. But it's not often we buy new non-current assets, but we still test for it. Of course, we have little questions. But the reason why we don't have occurrence happening is because most of the time, you're not buying that many non-current assets. Although we still check to see if there have been any additions and disposals during the year. We check all that anyway. So we don't typically refer to things occurring, if you like, or transactions occurring within the statement of financial position. No, things occur within the revenue, cost of sales, we bought goods, we sold goods, if you like. So we really test for occurrence, if you like. Did the transaction actually happen? So I can find evidence of whether or not a transaction actually happened, if you like, by literally walking through and taking a sample of, I don't know, whatever, 20 invoices from order to payment. And if I can walk through with these invoices, so you will see, and as Dudley highlighted, what I will do is I will show you some audit files where you would see someone write invoice A, B, C, D, E, F, G, and literally show you order date, if you like, when the goods were sent out, when the money was received, literally showing you that walkthrough to show you this actually happened, all to receiving the money in the bank. Completeness. This is another assertion. I'm testing completeness, and what you saw me doing with inventory there a second ago was testing completeness for inventory. Have all the transactions, assets, typically, again, like I say, liabilities and equity interests being recorded. Typically, again, I'm leaning towards, if you like, my here both, of course. So you can see why, right? If I have expenses, hopefully you're starting to click onto this fact that if I'm less likely to have completeness issues with revenue, because people want to overstate their revenues anyway, so they're going to have that. I'm more likely to see completeness with expenses. It's likely that someone won't include certain expenses in the year, right? Because expenses lead to debit, expense, credit, liability. Both aren't healthy for either statement, so likely to see that. Accuracy. Now, again, this is literally saying you would see me take a sample of, I just want to understand whether or not this figure has been put into the system correctly, if you like. Maybe I have a purchase invoice of £100, but instead we've put it into the system at £10. So I will take a sample just to check for actual accuracy of, if you like, of that figure. Now, the truth is we should see a problem when it comes to paying. But in terms of just accuracy, and this is just the accuracy of the amounts of the data itself, just has the right invoice figure been put into the system? That's, of course. So these are all the things that are helping me to be sure that the accounts are true and fair, that there is no material misstatement, right? That the thing occurred, that it's complete, that the figures in the system are accurate, if you like. I mean, the truth is we also, again, like I say, controls, when we look at controls, part of our controls testing would be to see that can a system reject, if you like, things that haven't been put in, if you like, so to speak, inaccurately, or can they pick them up? Now, you have to be forgiving on systems. If someone takes an invoice that's worth £100 and they put in £10, well, they've put it in, right? Now, when it comes to paying, hopefully the system would want to only pay £10, but if the system is saying that if someone comes back to you and says actually it's £100, we should see that within the system, and that should raise up some kind of exception and there's a problem here, that sort of thing. So that's that. So then we have another assertion, this thing about cutoff, and I talked a lot about cutoff either 2 weeks ago. And this is, have transactions and events been recorded in the correct accounting period? This is a big audit point. So you want to know this like the back of your hand. It's very popular. We test for it. I highlight it every time. It's an assertion. We are testing for it because obviously, if I have the 31st of December here, and if you want to make your revenue look good, all you do is you will bring in revenue for the sales invoices for the 1st of January, 2nd of January, 3rd of January. You'll bring all of those in here. You'll just bring them into this period. So you're bringing in invoices for the next period into your period to make your revenue look much better. Again, this affects both statements because you're going debit, trade receivables, credit, revenue. So trade receivables are overstated, revenue is overstated because you haven't had the right cutoff, or the cutoff has not been properly applied, or the client is being interesting and putting in things here. Remember last time I highlighted that Actually, this fraud, I mean, this is me treating this fraud. I mean, I know it's a tricky one. It is a fraud. So to explain really what's happening here, here's the problem here. Client dispatches the goods here on the 1st, 2nd, 3rd, 4th of Jan. This is the real fraud here. So the goods dispatch note, right? The goods dispatch note is showing the goods left you after the year end. So they were sitting in your inventory, making your inventory look good. But what you have carefully done is to raise the sales invoice early. So you raise the sales invoice and you have actually dated the sales invoice 31st of December, 30th of December, but the goods left your building post year end. So this is the real skill here. Hopefully, if you capture this, you're capturing a lot of the marks straight away. If you can understand that a client can raise sales invoices and put them through their system before the goods actually leave the warehouse post year end, so they still have the inventory in place, which makes the inventory look good. They've recognized this revenue early, if you like. That's why we have these cutoff periods. So you can have that type of fraud. I call that fraud. Here, this is innocence. This actually, the goods left the building. The goods left the building post the year end. They've just put all the invoices early and mapped it all together and recorded it. So somehow the system hasn't picked up that these sales invoices maybe dated the 1st or 2nd. It's just really you just being aware and seeing how you catch it. But people are, that's it. But the key point here is we have cutoff to help us here. So cutoff is one thing we're always looking at. But the key point you want to be writing out is that this thing should be in the correct accounting period. This is the other one. I mean, you might think straight away that this doesn't matter, but this is big. Classification. So again, referring to Natalie's work, all you have to do is you just have to recognize something that should be an expense as a non-current asset or an intangible asset, and we have a classification problem. We have a classification across, even I forget the error of, no, that's an error of let me test you guys. What error is, this is long time, old school accounting. No one's testing you on it. What error is it? James, I taught you A-level accounting, James. I'm expecting you to remember this. James, or anyone, what type of error is it when you put something, when you cross statements? Anyone? That's the first letter. You might remember. Yes? Error of principle. Oh, wait a minute. 1 second. Let me just check you guys are there. 1 second. Oops. Wait 1 second.
Yeah, we're here.
Oh, you're here. Right.
Yeah.
Sorry, I'm thinking, have I been talking to myself for the last 30 minutes? It's okay. I understand you're all muted because of internet issues. But error of principle. Error of principle. That's the problem, really. So you can have an error of principle. And or that's in general. But you can have errors, right? Even within. Now, I'm going to be honest. I raised my hand up. When I used to prepare accounts, as part of my, of course, training. I mean, I'm going to go to I'm going to go to Hannah and and Natalie and those who have done some accounts prep work. Imagine you're preparing your expenses, and you have, like, I'm going to go to the classic ones. You have telephone, you have light and heat, and then you have, I don't know, sundry. And this is 2000 and whatever, 18 and 2017. And this year you have this. Imagine you have something like this, 100, 300, and here you have sundries 500. But for some weird reason, the client this year has done some whatever, they've just messed things up. So this is looking like this is looking like 50, this is looking like 600, and light and heat is looking like 350. Because one of the procedures, when we come to procedures a lot, is to compare one year to the next. And I remember, no word of a lie, what I would just think is, well, look, this is sundries. I'm just going to transfer 50 from here to here. Because the problem with these analytical procedures is that once a partner starts doing this, because the system does it, he starts asking questions, and you don't have time. Like, you don't even have time to be answering questions about these differences. They're not even material. But this is accounts prep, not audit. So which is why it seems okay a little. Do you ever shift things around to make things look smooth? I feel bad asking that. Do you ever shift things around a little?
Yes.
Sorry. Because, you know, you know, and not just that, for cosmetic reasons as well. If you look at your accounts and suddenly you're looking at your ledgers and one you have here, I don't know, 100, and this is looking like 1,000. It just looks very just unsightly, especially where you have other um, um, codes that can help you ease that, especially when there might be an issue, especially with sundry, and you just journal them out, and because it's still all going to be the same total. But this is not an audit, this is just accounts prep, so everything looks nice and pretty and we can all go home. Okay, great. So I don't know, this has been recorded as well, but don't worry, no one of any is going to be reading this or watching this, so I can't get into trouble. Okay, great. So have transactions been recorded in the proper, so the key point here is that we want to make sure we classify things properly. And it doesn't matter where, again, like my key point here is, doesn't matter what classification I'm talking about. Even within PPE, you want to make sure that land is classified as land, buildings are classified as buildings, and vehicles and cars are classified as that. And even within those areas, classification is important because we can carry out analytical procedures right across every single different balance, if you like. So mixing them up, you can see why someone can mix things up to try and confuse us. So that's important. And then finally, of course, disclosures. Really important, very, very important, right? Because I mean, they're just as, again, I pick up on Natalie's work, which I want to highlight. This is really important. You want to highlight the fact that it's important to always mention the fact. Don't think we're just auditing the statement of financial position, statement of profit and loss. We're also auditing disclosures. Have all the disclosures been made? When I say disclosures, things that we cannot put numbers to, but we need to kind of let our readers know about as well as we can. So here are some of those very quickly. Here are some of those assertions. I've put them up again. Typically, again, you can see here existence. You can see here I cannot have existence within my statement of profit or loss. I cannot say revenue existed. It's a flow. It occurred. Can I say an asset existed? Can I say a liability existed? That's why we have existence within statement of financial position. So again, you can see why audit is purely technical. You're using the word existence when you're talking about doing some tests on assets and liabilities. You're testing for existence, right? It existed. I saw it, if you like. We can see it's there. This is another interesting one that people take for granted. Just because something exists doesn't mean you own it. Surreal. But just because there's a car there, or you might even have, in fact, you might have, I'll go to right to the extreme, you might have sold the car and you're literally just leasing the car back because you need some money or a machine, but you've not declared it. So you're still showing the asset on your statement of financial position as though you own it, which you don't. I mean, you may own it, but there might be sort of underlying obligations or security. It might be being used as security, possibly, yes, but that needs to be disclosed. Because when I come as an external, right, and I look at your business and I see car or machine, I think you own it by default. But if I look down in disclosures and I say, actually, we've actually secured this asset on a loan, and if we default on the loan, they take the asset, it'll make me think again about how I invest in your business. So these are the assertions I'm testing, if you like, and I'm looking for evidence for. And if I can find the evidence for these things, that you have the right to it, it exists, that's audit evidence, in effect. So does the entity hold the evidence? I'm looking for the title deeds. So whenever you go into test for, so I mean, another great one they can ask you, who knows, and that's brilliant, if they say that, oh, if you want to go, let's do some testing to see whether or not this business owns these assets, the buildings. I've seen the building. Thankfully, buildings don't move yet. Can I see the title deeds? Of course, you own it. You can, of course, directly inquire with the client whether or not there are any loans on it. But of course, I'll talk about, when I talk about loans, typically when the bank, typically bank accounts will send all, the bank will send all your loan accounts and anything you have secured. But who knows, maybe there's an external party you've carried out some kind of transaction with and not told anyone. And so, of course, management have to declare that they've told you everything. So does the entity control the rights to the assets and our liabilities, the obligation of the entity? And then, of course, the big one, again, we're very used to is valuation, if you like, at the appropriate value. So this is what we're testing for. This is a natural, we naturally think, is it worth that? But there is existence. Do you have the rights to it? And there's valuation. Now, I've talked several times about the mnemonics. This is the first of the mnemonics I want you to be very comfortable with. If you're trying to, this helps you with looking for evidence, right? So you know what you're testing. I mean, it's all together here, but again, hopefully you will see that there are some assertions that are naturally for, that can be for both, but there's some assertions that are purely for the statement of financial position, and typically some that are purely for the statement of profit or loss, and some do overlap. We're looking for completeness everywhere, but here so ACCA cover P is a typical one. ACP, you might, even if you remember ACCA cover, that's enough, and you can see what it means here. It really kind of really kind of classification, understandability. So really about disclosures, did it occur, value, existence, rights, and obligations. So these are your financial statement assertions that we are. So this is the structure for carrying out or looking for audit evidence. What you're really looking for is evidence of these assertions, if you like, over these balances. Right. So again, like I say here, you're constantly trying to link these assertions to your tests. And you're testing this. So you will see an audit file. What you will see is when it says, "Oh, test non-current assets," you will see existence. I was highlighting as done the requested. We'll see some pro formas. It'll test you. It'll tell you what to actually do to test for existence. There might be 6 questions to go and look to find, for example. Then it'll ask for valuation. There might be 6 questions, or if you like. Then it'll say rights and obligation. There might be 6 questions, things to actually go along if you do. And then there'll be completion. You see what I mean? So literally, once you answer those questions and you follow that procedure, you're answering the tests, so to speak. You're proving that that figure that they're claiming is what they claim it to be. So I think I try and separate them again here. Yes, so for transactions, statement of profit and loss, we're looking for occurrence, completeness, I talked about the expenses, accuracy, the figure there is what it is, cutoff, I talked about revenue, and classification, making sure they're in the right, if you like, in the right balances and you're not moving things around. And here in the statement of financial position, typically existence, you can see why rights and obligations wouldn't have happened in the statement of profit or loss. You know, it's not really, it doesn't fit there because it's about ownership and obligations, and these are about assets and liabilities, which is why it sits here. Completeness would be appeal to both, of course, would sit in both. Accuracy, of course, classification, and of course, valuation and allocation. Even here, you can see to a certain extent there is no valuation. You know, in my statement of profit or loss. You know, it's more about accuracy. Valuation is to do with assets, isn't it? More of the time, let's value these assets. You don't value an invoice, you just check for the accuracy of the invoice, right? You know, has the accuracy been put in, has the invoice been put in correctly, right? So hopefully, again, it's just about being technical and using the right terms. And once the examiner sees you, oh yeah, you know when to use the word value, you know when to talk about accuracy, and that helps. Okay, great. So I think I highlighted earlier on that whilst it's important to do all this for the numbers in the statement of financial position, statement of profit or loss, we cannot forget other relevant information matters in requiring their appropriate disclosure in the financial statements. So this is all in the notes to the accounts. We want to make sure that everything has been disclosed. Okay, great stuff. So let's so that's kind of assertions in general. So audit evidence has this general overview before we start looking at actual individual balances and what actual substantive procedures we'll carry out on there. But typically, in terms of how we actually gain this evidence, what procedures we actually carry out, we actually, like I said earlier on, the first thing, remember we talked about audit risk being made up of inherent risk times control risk times detection risk. Right from the planning stage, we want to understand the test of the controls. We need to understand the controls. I mean, this chapter is not on controls. This chapter focuses very much on procedures, but what we have to do is we have to go in there and document the controls in place. So even in your own language, if you're highlighting the fact that I would document the controls in place, I would literally observe the processes myself and come to a certain place of understanding and being comfortable with the processes, then I can decide that now that the processes are working, I can, not do as much test of, the other term for this is test of detail. I can minimize my test of detail, if you like, my substantive procedures. And that's how we gain our assurance, but actually collection of that information. So I talked about this again before, test of controls, just looking at the operating effectiveness of the controls. How well are the controls preventing or detecting material misstatement? Controls don't even have to be IT all the time. Literally signatures, authorizations. Yes, of course, having, batch control systems, double checking, review, that sort of thing is important. So yeah, yeah, that's the first thing. So I talked very much about having these internal controls. That's how we prevent and detect material misstatement. That's where we try and assess the level of control risk, if you like. That's the first there. That's really to do with control risk. And typically, I think earlier on in our earlier discussions, when we talked about corporate governance, good corporate governance, no organization can carry a 100% substantive testing. So we really need controls in place. It's important. I highlighted how after the collapse of Lehman Brothers, the Americans came up with this sort of rule, Sarbanes-Oxley requirement for all companies listing to have internal audit departments, to have internal controls well established, because we know that really and truly internal controls are what really safeguard the organization. And if we have good internal controls, we can rely on the numbers that are coming out. So just kind of highlighting again what I was saying here. So the stronger the controls, we can place some reliance and reduce the amount of substantive testing. So very quickly, in terms of audit evidence, first of all, like I've highlighted before, in your own language, whatever it is, I need to, like all things, before you start documenting, you need to understand, because of course, different organizations work differently. So you need to understand how the system operates, document the system, and then test, if you like, the system. So whether you use narrative notes to document the system, whether you use flow charts, questionnaires, however it is, you want to understand, if you like, the system. That's the first, I think that's the key point here from what I'm trying to sort of say. Once you now understand the system, you will then, to a certain extent, now discuss or think about the extent to which you will carry out actual substantive, if you like, procedures. If you like, again, like I say, this question of test of detail, if you like. First of all, I guess one of the key things you're going to do, first of all, is carrying out some analytical procedures. Again, like I said earlier on, even during planning, we're doing this. I'm looking for the risky areas. Revenue has gone up by, every year, revenue had gone up by 1%. Now it's gone up by 15%. That's been done via an analytical procedure. So that will make me then think I'm going to focus on revenue. Why has it gone up this much? I'm not accusing them yet. I'm just being a professional skeptic. And comparing, if you like, one year to the next in terms of my planning. Even during the year, I can carry out analytical procedures. I mentioned this here. This is a phrase I want you to use, put it in as part of your vocabulary for audit, a proof in total. I talked about this last time. I think that you can get a question that says, and I think it's TYU, it says that when do we use analytical procedures? Remember, we use analytical procedures prior to the audit, planning stage, during the audit, and at review stage. Proof in total is typically used during the audit. Very popular. Literally, again, like I say, I don't look at what the final figure is. I take last year's figure, apply inflation, and any changes, for example, increase in workers, decrease in workers, and I should get a figure of what I expect it to be. And I now compare it with what it is, and I look for how far those figures are. So this is me applying kind of almost like incremental budgeting type sort of thing. to see whether or not it's called proof in total. It's a procedure that we use during an audit, especially if I do this, if I can literally do that for all of, say, little expenses, and my audit is done of all those expenses. I can do some testing for accuracy and a few things, if you like, and completeness, fair enough. But in terms of trusting how much time am I going to spend, if the proof in total proves that, given what it was last year, and I did the audit last year, and I've done my adjusted for inflation and a few things, well, chances are I can trust the trust what's going on. So the first set of mnemonics that I required you to know were the assertions. Those are what you're trying to assert or test for. The actual procedures. Now, this is what again I can only I know Dudley has sent me some work actually, but Dudley sent me some work. And when you look at audit risks always tell you that identify the risk, and then it says, oh, what would the auditor do, or what would you come out with? Now, you don't have to go into core detail, but understanding the procedures helps you to start thinking about the sorts of things you would write about. They're not really even asking for detailed procedures, but it's the language. So this is the next set of mnemonics, or next mnemonic, that you need to be comfortable with. And they are actually quite straightforward. You could probably think of it anyway. But again, audit is about being technical. So audit is about using the language in that the examiner wants. So in terms of the actual procedures I'm actually going to carry out, what am I actually going to do? So what does that mean? So for example, you can get a question that can say, what audit procedures are you going to do to, for example, say to do the audit of bank, like we said. Now, what the lecturer wants you to do, sorry, what the examiner wants you to do, he wants you to use this language. It's the language. It's pure language. This is why audit is a technical subject. Reperform or reperform the bank rec. Inspect the bank letter. If you like, you're not really observing anything. Typically, this observation is typically for controls, but there's no real analytical procedure here. But you can see here that the language, it's critical that we're using the language of the technical language the examiners want. I said before that, maybe I haven't, that a word you should never use in audit. If you use it in audit and you see it, you use it, then you need to remove it quickly, is we never use the word check. We just never do, because check doesn't even tell us anything. I mean, in real normal speak, it does. But check what check, how are you exactly checking? I checked. To what degree did you check? I inspected. It gives a more sort of a purpose to how you checked. I checked. Did you observe when you say you checked? If you like. I checked. Did you recalculate? What exactly did you do? So check is like the parent. We're not really interested. We want to know, what exactly did you do? Inspected gives this impression that you use some sort of magnifying glass. So really important. So this is the language that you're using when you're talking about audit evidence, what it is you're actually doing. You're trying to prove these assertions that we've talked about. What did you actually do? So you did this to something. All these are, if you like, active verbs. If you like, you did it to a piece of document. If you like, accuracy, I don't know, I inspected 10 invoices. If you like, for to see whether or not the purchase invoice, the amount of the purchase invoice was what was exactly put into the purchase ledger. If you like, to ensure that the figures matched. That sort of thing. Okay, great. So that's the AEIOU. You can see the U is made up of two things: recalculation and reperformance. Yeah, I have known about AEIOU, but I found the slide, which is why I put it here more out of respect and a reference. Open Tuition, he had this kind of thing going on, and I liked it, so I sort of thought, okay, you know what, I'm just going to reference it. So that's why it's on here. The textbooks, I don't know if the textbooks actually call it AEIOU. They just list it out, which is fair enough, but I think it's good having a way to remember it. So ACA cover, you're thinking, okay, great, those are my assertions, and AEIOU, those are my actual procedures when you're writing. So like I was saying, really here, in terms of inspection, what did you actually do, if you like? So you've opened your audit file, you've gone to tangible assets, you're trying to test the assertion of existence, or if you like, rights and obligation. So what did you actually do? You can see here, I inspected the inspection of documents and records. I inspected the title deeds to see whether or not they are the actual owners, if you like. I would pretty much give evidence that the control is operating. Yes, I inspected a list of a batch of invoices to ensure the invoices had been stamped, if you like, to see. But the key point here is that whatever it is you're being asked to look at, you're using that language of inspection. So you're also inspecting to look at dates. For example, when I talked about cutoff, to look at the dates and the dispatch notes. You remember what I was talking about earlier on? That sort of thing. And again, this is because you have already gone through their system and understood that. I mean, again, I think, I mean, I don't know if, I mean, in my experience anyway, when you go into a warehouse, typically a goods dispatch note will leave with certain items. And I've never seen a scenario where a goods dispatch note is dated earlier than when the goods actually leave. So as soon as the goods dispatch note is prepped, it's leaving with the good on that day. So typically you can trust goods dispatch notes. I mean, it's a big fraud for just to do in 1 year. I mean, there might be errors in the system, but typically we can trust the goods dispatch notes and the goods receive notes are quite powerful. They really do give us evidence of when goods actually leave. You see, because all of this comes down to the definition of what is revenue. Revenue is when goods have been exchanged. We can recognize revenue when goods have been exchanged between both parties, and the rights and risks, the rights and the risks and the rewards have been kind of established. Then we can recognize revenue. So typically, we then go on to writing the definition. Typically, this is when the goods have been dispatched, or the goods have left the building. Yeah, again, these are just all expressions and ways of using the word inspect, if you like. Inspection of tangible assets. You can, again, like I said, you saw me highlight the right existence earlier on. Pretty conclusive evidence of existence. I've inspected, if you like. And it may give evidence of valuation. It may give some evidence of valuation. But this is we'll come later on, hopefully, to see what happens with using expert opinion. I mean, I'm not very good with cars. I mean, I started driving relatively. I mean, I've been driving now, yes, like since 2008. Fair enough, but the guys I went to school with were driving as early as, if you like, it was 2004. In fact, I only started driving when I started working, so I didn't drive at A level. I didn't. So I've never been great with cars. Like, I can't look at a car and tell you what, how much it's worth. I'm not very good. So typically I wouldn't say using inspection is the best route. Some people are great, good for you. If not, I would go to I always went to a source. I'd go to AutoTrader. AutoTrader was the popular source then. I'm sure there are better ones now. I'd go to AutoTrader and put in the reg of the car. And in fact, now HMRC, not HMRC, not HMRC, but .gov. There's a .gov website you can go and look at MOTs, and if you look at the number of MOTs and those sorts of things, they can give you more evidence about how roadworthy a car is. And so I'd use that to then look at valuation. But again, how well do you know the client? It might be to do with specialized machines. It's about adapting it on the day, isn't it? Right, okay. Yes, I think I've battered you enough. It's 10:49. Let me just go till 11 and then I'll give you a break. Okay, so observation, again, like I say, observation, as you can imagine, is very much about the controls, right? Typically you want to observe how well a control is operating, so to speak, because you're there on the day. Observation, again, big, of course, like I talked about, stock take, you're there, you can observe what's happening, but because we're really looking at controls, what can you see on the day? I think it's rare that you would just be observing for accuracy or that sort of thing. You see where I'm going. So typically, the procedure of observation is very much linked to controls. Again, like I said here, it's very much about on the day. Which is why, remember, like we highlighted here, this is important again, so that this embeds within you. Typically, if you're doing an audit for the 31st of December, you don't usually turn up on the 31st of December to start looking at controls. Your planning probably would have started somewhere in August. If it's a new client, you want to document the controls. Of course, if the client continues, you already have the controls documented. You're just looking at changes, right? Because typically, it's a new client, you want to understand what the controls are. So imagine you're in July. You want to go out early and observe and get a good understanding of the controls. You want to go out as part of the planning and document all the controls. We'll come later on and talk about how if the company has an internal audit department, they might already have documented the controls, but fundamentally, you want to go out there and document the controls before you actually get there for the audit, because you see, you need to understand what control risk is going to be. You see, because this influences the amount of evidence you're going to need to collect. Okay, so again, like I said here, this is what I was saying here. Observation of a one-off event, such as an inventory count, will be good evidence that the procedure was carried out effectively. This is inquiry. So, of course, inquiry in of itself is not enough. You still need to back it up with relevant documentary evidence. But there's nothing wrong with inquiry. You can still ask, because sometimes it's the beginning of the conversation. Sometimes you might not have enough information, but it will be backed up. We'll talk about the ways of backing information up if you can't find the information yourself. But it still needs to, it's not enough. You can't say, I asked. No, you inquire, but it could be about anything, a court case. You see, because most of the time you're not asking questions where you have paper evidence, where you can go in and do some testing, do some sampling, where you can test it to the market. No, but sometimes you just don't have that kind of information. Because again, like I say here, because responses generated by the audit client are of lower quality, just because there is a bias. There's a general inherent bias. They're unlikely to tell you what you want to know. So we need to still corroborate that information. We'll corroborate that evidence with some further information. So this is what I was saying here. So we have these things that we refer to as management representations are part of overall inquiries. So management, we'll talk about it later on, but management will actually write a letter to sort of say, listen, you were asking about this. We can tell you this is what it is. We take full responsibility of this. We're here waiting to hear from this court case. We have this client who sued us. I don't know. We have an employee who left us. Whatever. If you can't get in touch with the client, or with the third party for whatever reason, the management will put together a letter of all the questions you've asked and that you've inquired about that you can't have direct. This isn't the same thing as saying, because again, question 153, it might be 153. This isn't the same thing as saying that I think that Natalie did, where a company has, say, whatever, a number of inventory sites, and you can't attend that inventory site. So client says to you that, well, sorry, I can't. You can't attend it for whatever reason. You can't attend it, and client says that, I can tell you that the inventory there is worth 5 million. You don't just you don't accept that. No, you need to find a way. Well, again, first thing is there's a number of questions here. You don't just accept it just because you can't say, I inquired and the client told me it was 5 million. No. We need to ask a couple of questions. First of all, is it material? Maybe these guys run a 5 billion inventory kind of structure. You're like, you know what, 5 million is not that crazy. It's okay. We will accept this. We just want to see some evidence of trade, maybe. Or if it's material, then you're like, listen, sorry, your representation is not enough. We need to see that inventory. We need to go there, or we need to get someone to go there for us, some sort of client, a colleague firm or whatever it is. No one knows. But the key point is that you can see why management letters are inquiry and is on its own is not enough. Right. Yes. So confirmation. So yeah, this is a I'm trying to think when I had AEIOU, whether I had confirmation, because this is another big one. This is us getting, I guess this comes under inquiry, but this is also a very big one that you will use all the time. So, sorry, I'll give you a break soon, but a very, very important balance we test. You will do questions on this and you will just write this without even thinking about it. A very, very big balance that we test regularly after inventory, probably the next trickier balance, is trade receivables. And at the year end, imagine that's your aged debtors report. And at the year end, you have the usual 30, 60, 90, 120 sort of thing going on. And then you have the total. And you will have a list of trade receivables, a list of people, customers that owe you money. And what you do is to directly write them to confirm that that client owed the business that amount at that date at the year end. So it's a clear, direct, written. They themselves, like I said earlier on, evidence is most reliable when it's coming from an external third party. It's not that we don't trust the client, but as long as it's coming from a third party, we're likely to trust them. And for the client to respond and say, yes, we owed them X amount. This doesn't mean they're going to pay it. This doesn't mean it's been paid. This doesn't suddenly mean the bad debts are. We'll do a separate test for that. But just for existence, did that debt exist? And that's what we refer to as these confirmations. It's a great balance because we can also talk about looking post year end. I think I've seen Natalie's work. A number of you have highlighted that as well. I'll look post year end as well. Has the money come through? Of course, that was evidence that money was there. If you like, that was owed at that period of time, of course. But we still have this this method of confirming. And so the technical term is called a circularization. Circularization is the term. So we would send out a third party, or we would send out a letter to, if you like, third parties. But not just for receivables. We ask the bank to confirm in a bank letter. I've talked about that earlier on. We would ask I guess this all falls under inquiry. We will speak to the legal team. I've highlighted before, typically on most audit files, I think even on most accounting prep files, you will not only have the company address on the front page, but you will also have their bank, and you will also have their legal representatives, their lawyers, whatever, all on the front. So they should have that information. And of course, we have the minutes of meeting. This is a legal document, and if there are any discussions about this, we should be able to see that. And of course, you might have inventories held by third parties. So if this is an image completely held by a third party for you, for the client, we need to be able to write to them and for them to confirm. And we want all original copies sent to us, if you like, of this type of thing. So key point here is that it may give good evidence of existence of balances, of course, receivables, confirmation. Again, like I say, it's not about whether it's reliable, it's about the existence. They might not be able to pay in the future, but that's a completely different topic. Again, like I talked about, recalculating, very popular. We recalculate, if you want to recalculate wages, you want to recalculate, use proof in total, do your proof in total first, and then recalculate again to see if the depreciation figures match up to what they're doing. And reperformance. So typically, whilst you're out there as well doing a stock take, you can, if they tell you. So for example, with a stock take, you will see something that looks like this. You will have, I'm just going to say this is line A and line B and line C. So you have stock here. So what you literally have is a clean sheet, and you see now, again, as you can imagine, what you have is you have two people, and you will just have the name of the items, just the items. So let's call the items ZYB or bags, whatever. These are different things, just bags. And so the actual item. So you have one person here looking at the items and counting them. So he counts them and he says, oh, there are 25 bags. You have the other person down here who writes 25. He counts and he says there are 52 dresses. This guy writes 52. Now, the point of this is that neither of these guys actually know the actual number. Otherwise, they might count 24, 23, and suddenly look at the piece of paper, well, it should be 25. I'll just say 25 because I can't be bothered. No, what we want to know, if you like, is whether or not if you like, we want to keep the actual number hidden from the people counting, then we go along and we actually recalculate the counts as well. A few lines, you just count a few lines as well. So you can reperform a few lines as well. You can reperform the bank rec as well. Okay, right. It's 11 o'clock. I'll give you a break and we'll come back. So we'll come back in 15 minutes and we'll carry on. We'll carry on. Right. Hi. Hello. Welcome back. Yes. So yeah, just to make is everyone back? Are you all, is everyone back? Are you
Yes, I am. Hi.
okay, great stuff. Yeah. Good.
Right.
That's cool. Great stuff. All right, let's carry on. So we're looking at audit procedures. And again, like I said here, analytical procedures are audit procedures that happen. We're talking about what's going on. Remember, I've highlighted the key point about the good thing about analytical procedures. It's not impossible to get it for a little 4 or 5 marker knowledge question, is that we can use analytical procedures during planning to understand, to understand, to compare the organization's revenues to the market, to look at their ratios, to look at wherever we suspect some degree of manipulation right from the beginning, just to understand where the risk areas are. We use it during the audit. So I've given you the classic term I want you to use and remember to memory all the time. Is this, oops, sorry, is this, so this idea of proof in total. I'll explain how that works. And as well as just comparing during the audit, just comparing balances from one year to the next. Again, also comparing to ensure good classification. So even within inventory, you never want to take, I mean, again, yes, I want to be, again, careful here, just so that my time doesn't go. You would never, here's the first thing I wanted to highlight that you would never do in an audit anyway. You wouldn't just say, oh, revenue, here we are, here's revenue. This year it was whatever, 1.5 million. Oh, this year it's 1.6 million. Oh, we're done. I've compared one year to the next. So it was 0.1 change. No. We need to break down revenue. The same thing even with inventory, guys. Right, that revenue, most organizations will sell a series of products. So you literally want to get that series of products in a spreadsheet, literally compare the movement of one type of product to the next. I mean, the information is there. We have the tech for it now to highlight where the real risk is. Kind of what I was saying earlier on about the inventory. Same thing with inventory. I wouldn't just look at inventory. Some inventory might be moving very quickly. Some inventory might be moving very slowly. If you just take inventory as a total from one year to the next, you will have things mixed up. You won't really know anything. So I need to break up inventory into the different lines and then compare the trade receivable days between those lines. Right? So like any good financial sort of analysis, you always want to be breaking up data. You say that, you've scored all the marks. Examiners, I think, get frustrated with students who just say, oh, well, in revenue or gross profit margin increase from one year to the next. No. They want you to say, as though you're working in real practice, I've broken down the actual figures and I'd be looking for that sort of thing. I mean, I remember there's a classic case of a taxi business that was very interesting, where, I mean, of course I knew that taxis operate differently, but I mean, to understand the classification, there's day, there's night, there's contract. So, and the ratios are remarkably different for all these three. But of course, if you just take the average gross profit margin, for example, and compare one year to the next, you're not really doing any real analytical work. I guess that's the sort of scrutinizing, isn't it? And looking for relationships. So that's what we're really trying to do, understand those relationships between data and then infer and make decisions. Cool. So that brings us to the end of our AEIOU type sort of understanding. And then the chapter goes in. I mean, again, a lot of this is just looking at general theory before we start looking at actual collection of evidence, which we will hopefully spend some more time doing next week, looking at individual balances. But again, the fundamental to all of that, again, is here and all these ideas. And the first of those is this idea of sampling. And again, I doubt if any of you would be coming across this term for the first time. But I guess the argument, again, is one of judgment. If there is a small population, I mean, a sample is an extraction from a population. If there is a small enough population, you would test everything. You would literally look at all of the items because that's what you would really like to do. But if there isn't, if you can't look at all of the items, of course, then that's why we now go to sampling, because we take a risk-based approach with audit, if you like, which is why we can only give reasonable assurance. And we hope that our sample will be an expression, if you like, of the entire population. That's what we're hoping. So it means that we need to come up with so key point, let me just kind of go with the slides. Key point is we need to sample. It's impossible to test everything because of course the costs involved, and you just can't. It's not, I mean, again, like I say, sometimes coming back to WIP and raw materials, I mean, you're not just going to be able to do that. And finished goods, it's not possible. So we need to have a statistically valid method of drawing a sample, if you like. That's the key point. Yes, again, like I say here, and even if, I mean, we don't give absolute assurance, but even if you talked about absolute assurance, this is just counting. There's still the valuation and the judgment with the accounting policies. So anyway, you cannot give absolute assurance even on that basis of those problems, even if valuation was possible, but policies would stop absolute assurance working. But because we don't give those, and therefore we accept that we have to sample. So we need to understand how we effectively sample. So again, as usual, I'll start with the standard ones, and then again, it's all about judgment, you know, and proving to yourself, well, this is what I would do. So again, like I've mentioned, typically it's very much about a probability, statistical driven method that is used to extract a sample that is, if you like, neutral and fair, and it gives us a chance of getting a picture of the entire population. That's what we're trying to do here, and not to be lazy. And I've seen evidence of when people have just willy-nilly done sampling poorly, and you do get, if you like, very poor results. But again, we have statistical and we have non-statistical. So like where I was saying, for example, where you have inventory and you have 3 lines, where this line here is worth 5 million and this line is worth £100 and this line is worth £100. Well, no, I'm going to focus. I could probably, personally, it depends on what materiality is, but if I would probably even just focus here. So I've totally ignored. These invoices might be for £1 each. This is why it's so important. You might actually have 100 invoices here. You might have 100 invoices here, and you might have 5 invoices here. So you see, if you go with pure sampling methods might say, take 2 invoices from each, something like that. Your results might come out and say, take two invoices from here. I'm not even bothering with these 100. If you see what I mean. So the question here is, this is where I just totally ignore, because I can use my judgment to focus here, and I'm going to look at all 5 invoices here, but I'm not even bothered with those. So you have non-statistical sampling, very much a matter of auditor's judgment, and in reality, it's a mixture of the two. But we start off with the statistical sampling, and trying to basically capture or imagine what the entire picture of the population would look like. Now, again, typically a matter of judgment. Argument is, and it doesn't matter what we're talking about. I mean, here we've talked about procedures here, we're talking about assertions. So let's talk about accuracy. I think accuracy is a good one, first of all. So you can sort of see where I'm going here. Accuracy is evidence really of control. You see, because you see, ultimately, if we allow for an organization to, if an invoice is, say, for a £2.50, and someone's putting in £2 or £1.85, there might only be maybe 10 of those invoices, so the difference isn't a lot. So you might think, well, Owen, it's not a lot, so I'm not really going to focus on the tiny amounts. You can say then, okay, Owen, I'm going to focus on the big amounts of, say, 300, where the person is putting in 250 and that type of thing. But accuracy, very much, the argument becomes that when you have these little problems repeating themselves, then you are likely to have errors right through the entire population. So, so I'm just giving you that picture to start. So then let's talk about this now. Let's talk about the different sample selections. Again, like I said, I doubt if anything new. The good thing about random sampling, to a certain extent, is that chances are that we will kind of pick something from every population. So this is your standard first batch approach. If this is your entire population of 100 invoices and you want to look for accuracy across the population, depends on how it's arranged in the organization. They might arrange it in months, January, February, March, whatever, up to December. They might arrange it according to letters, people's names, clients. Doesn't really matter. You might decide to pick, if somehow you decide to go for 10 invoices, you might pick one from each month. And to be fair, or maybe whatever, 2 from each month. Given this, if you're looking for accuracy, chances are you don't care whether or not they're big figures or they're small figures. You just want to make sure things are accurate. That's what you're testing for. The test isn't accuracy of big things or small things. It's really a controls test, ultimately. How accurately are these things being put into the system, and is the system picking them up? And that's what we're really looking for. So a good random selection approach, if you like, would work. Now imagine you had, again, IT, big systems where you have thousands of invoices. So you can just automatically tell your computer to pick up, because we'll talk later on about how we have IT now helping us with a lot of the work we do, to pick up every 10th invoice or every 50th invoice. So again, this is still very much about wanting to cover the entire sample and make sure you get an understanding of what's happening right across the picture. And that's kind of, so you see what I was saying there, where I had, and that's what I'm looking for, those type of things: accuracy, completion, that sort of thing, just to generally go through the whole sample. You could focus on the higher amounts. So this is what I was saying earlier on. You need to sort of think, okay, listen, I need to now think about this here. I have a little tiny little invoices, like my £1, £1, £1. So I might put things in blocks. I might say, you know what I'm going to do? I'm going to go for spend a lot of whatever, anything over £250. Yes, I want 20 invoices, but bring me 15 invoices from here and bring me 5 invoices from anything lower than £250. That sort of thing, if you like. So because you're more interested in the materiality and you want to make sure. So you can see that auditors have to make a decision ultimately to see where their problems might be. You might not follow any structure. You might just pick it, you just really, if you like, haphazard. The thing about random is sort of saying, I'm going to go from, I'm going to pick 12, but I'm going to go right through the year. So random does have it's very different to haphazard. Haphazard means you could end up picking 12 from just the first 4 months. But random means you're actively trying to make sure you pick one from every area, right? Because that's the whole point, so you get an understanding. Block means you're just focusing on one area. So again, like I say, you might just be focusing on everything happening in the month of December. It's not spread right through. I mean, there might be reasons for this. It's not typical. And block can mean many things. I almost want to call it cluster. Like what I was saying, I was only focusing on the 5 million, so that block of inventory, and not interested in the rest. It's not typically appropriate, but again, you're just trying to prove that number is true and fair, and it doesn't really matter about the ones you're ignoring. If you can prove that, no one is going to disturb you. And so again, here, this is what I was saying. A non-statistical approach is you actually just choosing how you do things, avoiding I'm just going to pick these particular items that I'm interested in, and this might be from experience. So really, again, that's the way to do it ultimately. But every system will always give you a calculation of how many invoices you should pick. The system can't, well, I imagine, to be honest, maybe now sophisticated systems can tell you where to pick them from. Possibly, why not? But typically you still have to make the judgment. Again, let's even think about this. So hopefully you can see where I'm going here. The inventory is still the best way to illustrate this. You look at the lines, if you like. Even revenue, you look at the revenue, you look at the clients. Some clients are coming with the bigger numbers, some smaller numbers, and you're thinking, listen, I don't want to go and end up picking, just smaller numbers, when I can be focusing on big numbers where there might be valuation issues, because that's what I want to be looking at. The big, I'm interested with regarding valuation. I'm interested in the big numbers. The small numbers, not so much, if there are not many of them. Okay, great. So what is the risk? You might carry out a brilliant sample. You and I know this, do a brilliant sample, and you might still end up picking a picture that does not represent the entire population. So all the errors, you've picked up all items that for whatever reason are fine, but there are still lots of errors there, and your sample just didn't pick up any of those. And unfortunately, that's a sampling risk. There's a risk here that you have missed what the entire population looks like and said things are true and fair are fine when they're not. Things is this understanding. But a non-sampling risk, if you like, here, if you like, the argument here is once you find a fault, you increase the sample size because that's an indication that there's a problem in the sample. So let's check a bigger sample. But that's the risk itself. And then of course we have what's referred to as a non-sampling risk. I didn't even have that here. I thought I did. A non-sampling risk, which is where you have not carried out your sampling techniques well. You've not been technical about it, and you've not been competent about it. And so in the end, you actually fail to pick up the errors just due to bad judgment or not picking up the right samples. Or finding the errors. So if you remember that the detection risk, both of these sampling risks and non-sampling risks came under detection risk. So this sampling risk and non-sampling risk is very much to do with the work of the auditor, if you like, and that's kind of there. That sort of scenario. Okay, great. So that's a bit of a theory. Here's another, again, a lot of knowledge type things, and that you can get asked in a little 4 or 5 marker. Hopefully, if you underline these and you see them again, we probably will have to come back again to them and to understand what's going on. Now, of course, I mean, I'm not even going to go far. I'm just going to stick with Excel. Microsoft Excel. And typically, when I say Microsoft Excel, to use this as my way of dealing with this. So typically, now with very large organizations, definitely, I know the one Dudley works for. I think Dudley's the only one in management accounting. The rest of you, oh yes, of course, and Graham as well. Your organizations, definitely, you will have systems, large systems within your organization. Now, you're dealing with so many transactions, and sometimes as people are becoming more and more, of course, we're becoming more and more digitally enabled. I can test things now, even from my office. Many invoices are now held digitally, as opposed to once upon a time. Definitely, when I was training, you see this big drawer, you pull it out, you pick out the physical invoices. But now so much is being kept online, invoices, orders, so I can follow all these things online, which is what we're all being forced to do gradually, aren't we? As we continue to deal with this whole thing. So we now have software that can deal with this and still carry out audits from afar. So I want to first of all talk about this idea of audit software, start from there, test of detail. Sorry, one second. Right, yes. I've negotiated with the little people to be a bit quieter. Right. It's not their fault. You know, they've been locked up for this is the 23rd of March. It's been tough.
Jesus.
It's been tough. I feel sorry for every little person right across. I don't even know. It's tough. So, Audit software, like I was saying. So we now have, I mean, Microsoft Excel would do the job, but there's a lot of software out there. But again, I refer to Microsoft Excel, that through some gentle implementation or we're doing it, we're all logging in to our systems from home. So as long as the client is happy, the client will allow, if you like, the auditor to log in to their software or into their systems and extract, if you like, and literally log in to their systems. So these are computer assisted audit techniques, if you like, that we're dealing with here, and extract the information from the client software, if you like, into their own kind of so extract the client's information from the client's extract information from the client's portals and systems onto, if you like, into their own kind of software. And again, like I say, Excel. So imagine you are extracting ledger on revenue from your client, from Sage or whatever, into Excel. As you can imagine, you literally just pull everything into Excel, and there you can test for accuracy. You can add everything up together. You can actually match things. You can look at the order to the invoice to when it is paid. So fundamentally, what do you want to do? What's your tablet to do? Yes, so you have yes, threaten them with the iPad stroke fire tablets, and everyone behaves. So that's worked. So you have this extraction of data from the client's portals, and that's what's really happening here with audit software. That's what we're trying to pick up on, test of detail. And so we can do a lot of work from our offices now. This next one, so and this is a nice 4-5 marker, and that's all you're literally saying. You think of basically me saying, can I work from home and do all my testing? Yes, I can. The next thing here is me actually testing your system. So when I say test data, call it dummy data. I throw dummy data at your system and see whether or not. So typically I probably will be in your offices to do this. I can still do it from external, but now I'm just testing controls. So this isn't like me, you can see where I put here test of controls. So I throw dummy data at your system. It doesn't really matter where I want to start. Let's just say, for example, you and I know typically that before we allow even for sales orders, we typically try to put the client onto our system. So there's standing data for the client, if you like, in management accounting, so that as soon as we start working with the client, they have credit limits. If I just want to test controls, so first of all, I can test it by trying to put on a false client and to see whether it will be authorized, or see what steps how long, or what steps it would require for me to actually put on standing data. I can try and change standing data. I can try and change discount codes. I can try and increase credit, or I can actually try and sell something, or to enable a purchase go through, to see whether or not a credit limit would be exceeded. I can try and change a credit limit. If you like, I can just try and put in an invoice and to see and put in a different figure to put the different figure in the total box to what I've put in the actual entry box, to see how the system deals with this difference, if you like. I can try and look at to see whether or not, if I put in 10 items, whether it'll stop me and they'll say add those 10 first before you carry on. So those are the two fundamental categories of how we can use software as auditors to work with our clients. First of all, to just do all our procedures, to inquire, to recalculate, to reperform, if you like, basically our AEIOUs, or to just test the integrity of this control system. So typically I'd be doing this first in my planning stage, and then we'll come here. Okay, I'll run through the theory now, but very quickly. So just so that if you picked up because sometimes in the books when you're looking at them, it's all very they're blank. It's all just theory, but it's important to kind of be aware of this for knowledge as well. So what am I saying? Software can be used to interrogate a client system. I mean, again, like I say, I've said you use Excel, but we do have specialized software for this, packaged off-the-shelf software, or of course, the bigger you are, it can be written specifically to the client system, if you like. But nothing is difficult now in this world of implementation. Nothing. You have people writing software to enable us to be able to log into different systems now, don't we? And we can deal with large volumes of data now, really, which would be once upon a time inefficient to do manually. And as I know, as trade becomes more electronic, we imagine you're dealing with a bank, auditing a bank. I mean, there's no way you can be sitting there doing a sample of 10 or 15. There's lots of things, lots of transactions happening ultimately, isn't it, at once. And so again, like I said here, you can extract samples. Once you extract the information into your software, you can extract samples, and you can look randomly. You can just imagine what you can do with Excel. You can pick figures over a certain amount. You can structure the information to do whatever you like, over a certain amount, below a certain amount, look at certain dates. You can analyze cutoff. You can do all of that once you can calculate ratios, so all of this happening here with test of detail, stratify the information. So just imagine literally every way of analyzing information can be done as long as you can get that information into your own system. I mean, this is all pushing it a little, but you can start to produce letters to send out to customers and suppliers. Yes, of course, but key point here is that you can trace transactions through the computerized system. I actually think this has evolved to the point where you literally can just go in to the client's systems and just be, as if you like, a guest, and then follow through, create a dummy section and follow through. You don't even need to extract it so much. You can extract for recalculation and reperformance, but otherwise you can perform, if you like, certain a lot more procedures now. I mean, there's lots of other procedures, but again, like I said, like when you were sending information, trying to confirm trade receivables, that will always still be done externally because it's a third party. But when we're just trying to perform procedures within the information that we have, this is good. This helps. So I was talking here about test data, and we're just trying to see how the entity reacts, if you like. And ultimately, we're trying to test application controls, if you like, within the system, because I'm submitting dummy data, if you like, into the system. Again, you can see what it's saying here. I'm putting in dummy data with errors and whatever. It doesn't really matter. Customer, supplier, it might be to do with wages. I could try creating a new employee to see how it works. I've done this a lot, putting 2 invoices with exactly the same dates and to see if the system picks it up with exactly the same number, because that's what happens when you put things in. If they get tired and they put in the same information, does the system pick it up? So these are the kinds of things that lead to whether that total figure is accurate, or how inaccurate or inaccurate it is, because the system hasn't picked the problems up. Right. And I guess, I mean, this is just general speak, but the argument is that typically, do you do this during the downtime of the organization, and do you do this during the when not much is happening? Now, just picking up on a question, a very popular question to do with systems, and Natalie did pick it up when she did the question. Typically, you get questions where it says that an organization has had one system, and for whatever reason, they've either had to transfer to another system or they've had to outsource their systems. Doesn't really matter. The point is we have a difference in systems. Now, you and I know, you and I know, we're good, thankfully, because we're all accountants, that One of the most important balances that sometimes we might take for granted, but you and I know probably the most important balances are the opening balances. Doesn't matter what you do during the year, everything can be perfect. But if the opening balances are wrong, your closing balances will be wrong. Now, typically, when I say the opening balances, if you're transferring from one system to another, you want to make sure that the closing balances from the old system equate to the opening balances of the new system. And this is simply because when you transfer from one system to the other, now it depends on who did the journals. It's as practical as it is. When this transfer happened, there might have been some information loss. This is not abnormal for IT. So we don't need to know the technicalities of it, but we need to understand that information gets lost, or we need to confirm the closing balance that the information and closing balance is the same as opening balance on the new system. But that's just, by the way, that's just a side topic when you come to talk about audit risks. Very popular audit risk, a transfer of movement to one system. Okay, great. Where are we? So live tests, of course. Yeah, so this is what I was talking about here. When are we doing this testing? When are we doing all of this work? Is it when the systems themselves are live? Because there are risks with working with systems when those systems are live. We need to sort of, to a certain extent, see how we can work without interrupting the day-to-day business of the organization. So key point, like what I said here, little knowledge questions. We can independently access the data without dependence on the client. We can test the reliability of the software, and we can increase accuracy of audit tests. We can be more efficient, cost effective, right? We don't have to be on site. But problems, of course, they are expensive. There's a matter of data breach, if you like, and data integrity, and it's difficult sometimes, isn't it? And again, here this question of potential incompatibility with the client's computer system. So these are some of the problems we can have. I think those are the main points there that you need to be happy with. There's this little point here where you can have software programs that are embedded within the client's system. I've never seen you never get anything that crazy. I think they're just pushing it, really. But the key point is, as long as you're aware that we now have, sorry, there's fixing working outside, so hopefully you can't hear too much of that noise there. But the key point here is that you can have all kinds of software can do so much now, where you have software and programs written into systems that just relay the information to your end, if you like. But that's just by the way, if you like. Yeah. Okay, great. So that's that on CATs and computer aided assisted techniques. Right. The next area is using the work of others. And as you can imagine, in terms of audit evidence, you cannot know, again, for many reasons we'll look through, but again, as you can imagine, you might get a job as an auditor to audit, to go and do a factory, a chemical factory. Now, financially, the issues are the same, but in terms of valuing the inventory or sometimes valuing certain machines, you might just not have the expertise. It's not the end of the world. All you have to do is bring in an expert to help you, which was part, if you remember, we talked about at engagement, part of our planning. These are the kinds of things you'd have picked up at planning and said, listen, we don't quite understand the inventory. When can we get an expert to come in and get the data in? And things like that, have all that agreed, if you like, before you go in. So it's very part of this big context of collecting audit evidence means you want to make sure you have an expert who is around if you cannot do it. And I guess the next question is, to what extent can we rely on the work of the expert? So again, like I highlight, you don't need to be an expert in everything, but ultimately we need to see how we go away and get that assistance. And like I said, a number of things here. It might be property, oil reserves. A big one that most, I don't know if, yeah, I mean, to be fair, That's not entirely true. Some audit firms will have a pension department that can do the valuations for you. If you can't, you have to outsource and call up an actual actuary firm and ask them, please, this company has a pension scheme. We need to know what it's worth, right? Because many organizations, if you like, will have pension schemes, and if you like, to a certain extent. I guess first, let me explain kind of briefly what I mean by this question of a pension scheme. Now, your companies will all deduct a certain amount of wages. Occupational pensions will deduct a certain amount of money from your salaries, unless you opt out, of course, and send this to an organization or sort of a fund manager to manage on their behalf. That's how it pretty much works nowadays. Now, typically, the pension scheme, either the company that has taken the money for you will let you know every single year how much you need to. Will tell you, oh, listen, you have 50 employees. They will live for this number of years. This is how much their salaries are. You need to send us this amount of money to keep up to date. So they deduct from your salary, but they also pay a certain amount as well. So not only are you paying, but your employers are paying, if you like, as well. So you do need expert opinion here, typically, for this. But if you like, some companies still do a lot of this themselves, so you need an expert to come in. Typically, you can have specialist inventory as well. Doesn't really matter what it is. I think it's just the awareness that we might need an expert, and there are certain guidelines that we need to go with. But again, I actually think that the more you become a professional skeptic, and you start realizing that the answers are the same all the time. So it's not like I'm asking you a new question. It's just like, okay, how would I deal with, what steps would I take to ensure that I can trust the work of an expert? That's all. So I need to assess, again, are they independent? If you like, are they competent? Just make sure that I can trust their work. So in whatever language you wish to use or discuss it, you need to see, can I trust the work of this expert, if you like, and what is their experience? Are they professionals, so to speak? So again, like any engagement, you are engaging an expert to carry out some work on your behalf, in effect. So the expert needs to know what their responsibilities are, what the scope is, when are they going to do it, if you like, what exactly it is you want them to do. You want them to value these buildings and give you an accurate valuation of the buildings. And again, like I say, you need to let the expert know that you're the one who's engaged them, observing confidentiality, and then, if you like, assess the work at the end. You still have to assess it. You are still responsible for it, but you have engaged with this external party. I think that's the big point there. So yeah, I think this is to understand what assumptions they have made and get them to break down that information into simple speak, so that you can clearly articulate and defend what it is they have said that is going on, if you like. Again, this is sometimes, hopefully, when we do F7 in September, that will be the first time we'll be looking at financial instruments. Now, many organizations are holding on to these derivatives. There are all these fancy new financial instruments that many organizations hold as assets, and many auditors don't deal in them, so they have to get experts, so to speak, to come in and just give them some advisory on the valuation of these financial instruments. So it's nothing new, needing experts to come in. Right, and then so the next section really is, after talking about experts, is using the work of internal auditors. Again, highlighting the fact that internal auditors can do a lot of work for us. They can help us out big time. And fundamentally, they can help us out in evaluating control risk. You expect, because the question is, what are they doing then? First of all, internal audit would be there to document the controls in place, test the controls regularly. So if we can rely on the work of the internal auditors, we can just go in and do minimal substantive testing. So again, it's the same process, because they are supposed to be experts. So the same principle that we would apply to dealing with external experts, we would apply to the internal auditors. How qualified are they, if you like? How experienced, if you like? How independent are they? Because remember, the internal auditors weren't supposed to report to the financial director, supposed to report to the audit committee. So if the internal auditors find something, are they able to talk about it? If they find a fraud, they are responsible. Of course, part of their work is looking for that type of information. It's internal to the organization. So that's really the issue here. If we want to fundamentally rely on the work of internal auditors, I mean, we can use internal auditors for a number of other things, even stock takes, but it's very much trying to assess the degree of independence, if you like, of the internal audit department. So if there's an effective element of the control system, then we can argue that we can reduce the control risk and reduce the need for detailed substantive testing. So again, like I said, we've already done a lot of this kind of analysis at the planning phase, because control risk, right, is assessed heavily before we start doing any work. And if we can rely on them, that's a good thing. Yes, I think that's the big points. So what we do is we, see how objective they are, technically competent, look at their work, and if we already have good, effective communication, and then we can incorporate their work, their planning, into our controls testing, and work with that. But again, like I said, even with the work of the expert, we still have to review the work and ensure that you have the people with the right technical training and proficiency. Again, everything else, again, the same language over and over again. I won't bore you, but the key point is it's supervised, reviewed, documented, because we are relying on this work and we want to still sort of say that we have investigated and carried out the right sort of review of their work, so we can now rely on it. So like I said, of course, they can always, do some work for you, because technically they are independent, but unless there is some particular restriction, but otherwise we can rely on them, although they are working for. This does not in any way take away your responsibility. You are still responsible for the work. But you see, this is, again, like I say, as long as you're able to highlight the factor here is that they are actually independent of management, if you like, and really are responding to the audit committee, and therefore also working in conjunction with the external auditors, right? And at any time, who knows, you can have scenarios where internal auditors are having lunch with management and telling them what they're doing for you, and then you now have problems. Okay, great stuff. This might be the last section. I don't know. Sorry, well done. All quite theoretical, and hopefully we'll do some actual testing next week. So this is becoming more and more popular. And there's a big slide I want to highlight, but the most of it is kind of obvious. So key point here is that nothing new. I know that Dudley works for one of the big ones, Iris. So you have many organizations now that will outsource a lot of their business functions. This is becoming very normal. It's actually almost the norm. And there are disadvantages and advantages to this, of course. So some of the big ones: payroll, receivables collection, pension management. I've talked about a little earlier on. So the question here is that because you're not the company isn't doing the actual process anymore. They've outsourced this process, but they're declaring a figure on their financial statement. So they're saying their wages are whatever, 10 million, but I don't have any way of testing this, right? Because this work and all the processing that goes to calculating this figure, they just get sent a final figure from the service organization that your figure is 10 million, put that down. So in a way, question has to be, well, I need to kind of go and talk to the service organization, but I'm not their auditor, and they're not going to just let me come in and start auditing their systems. Why would I want to do that anyway? That's a lot of work. So I need to be able to rely on the work of the service organization ultimately, right? And I'll take you to the key slide that I need you to be very comfortable with. But the key point is, what I'm saying here is nothing abnormal. I need to ultimately, at the end of the day, get sufficient appropriate evidence that we can trust that organization. That's kind of what the issue here is. So I need to take that into consideration when gathering this evidence. So depending, of course, to the extent and how material this figure is, might not be very large, so it doesn't matter. But it's very much, again, about how material or how much work has been outsourced, if you like. And that does matter. So what I need to kind of get is that I need to get an understanding, like all things, of this service organization. I need an understanding of the services, what they do, their internal controls, the transactions here relating to us, how much interaction happens between the service organization and the entity, just to get an understanding of what's going on here, the reputation of the service organization, external supervision, controls in place, experience of errors, how much can the actual client go in and actually, well, not go in, but can they monitor any of the work, or do they just accept? Now, this is the key slide I want you to do. This is where all the marks are. So typically what you would do is, as an auditor, you would ask the service organization to send you a report. Now, this report will come from the auditors of the service organization. So this is very normal. Service organizations will have an auditor, their own auditor, who can prepare two types of reports. Now, this report is really for the benefit of the clients of the service organization. You see that, listen, we're their auditor, they have good systems in place, they're all right, if you like. So you can, so from one auditor to another auditor, you can trust our report. And ultimately, you want to clearly, this is where the marks are, so that the examiner is clear that you actually understand what's going on. So there's two types of reports. There's a kind of basic type 1 report, which just says, these are the controls in place at the service organization. These are descriptions of the system and the suitability of the system. So it just kind of gives you an understanding of what the systems are, and that's it. You may rely on that. But again, like you see, this depends on how material this balance is to you. But you might just want this report in there. You're basically speaking to the auditors of the service organization. Basic report. We just want to understand the systems. Good controls. Okay, yeah. Figure's not material anyway. But a type 2 report gives a much more detailed description, if you like. What you need to just really be able to do is to say there's a type 1 report. The report is not that detailed, just gives an understanding of the controls in place. But here we have a much detailed report, the description, the operating effectiveness, if you like, an opinion, if you like. So basically, they basically want the auditors of the service organization to carry out an audit of the service organization, and their controls, in effect, really more an audit of their controls of the system and the suitability of the controls, the effectiveness of the controls, and description of the tests of the controls performed by the auditor. So you can see a much more detailed report stating what it is you're doing. Very good knowledge question. They can come out on service organizations and audit evidence. Right. And I mean, well, yes. I mean, there is this bit. If the auditor intends to use a report from a service auditor, they should consider, yes, of course, the competence and independence, contacting the service organization, visiting them, and using another auditor to perform the test of control. But typically, what I've noticed in your exams is they just want you to understand that there are two types of reports, and if you want to rely, on the report, if you want to rely on the information, depending on the materiality, you probably will be asking for a type 2 report. That, of course, will be more expensive for you, but you can imagine that's there. Now, like I said earlier on, this is not a bad thing, having an external organization do this work, because one, it means that they specialize in it. Chances are that it's their work. Why would they want to be incompetent? Chances are they are actually very good at what they do. They're specialists. They're running a business. So competence, they are specialists, likely to be fewer errors, if you like, and we can rely on their auditors again. So in a way, there are benefits there. Again, it is third-party information. So you saw we mentioned this right at the beginning of the class. It's third-party information, so we can really rely, if you like, on the work of third-party. But the key point here is it's just gaining access, really. That's sometimes the problem, gaining access to the records and hearing from them on time, and they might not want to speak to us or get in touch with us, and we tend to have that type of restriction, if you like, most of the time. Cool, great stuff. Well done on getting through 123 slides. So great stuff. So yeah, so that's kind of that chapter. What we will do, we will carry on next week, and we will start looking at actual evidence areas. So we maybe start looking at trade receivables, inventory, revenue, so looking at systems. But I have a feeling that the book does the systems first, so you understand what the systems are before we start looking at the evidence to do the systems. So it might be systems first, but it doesn't really matter. We'll just continue in step by step, and continue to cover. Again, I recommend, please, even if it's 1 or 2 questions a week, it's good. It is time consuming, trust me. I appreciate that, and you guys are very busy as well. But if you can do at least 1 or 2 questions. Sorry, James, I thought that exam kit was the right one. I'm going to have to get you the right one. It's the wrong one. They sent me the wrong one, so I'm going to have to get you the right PDF. Have your books arrived, James?
Oh no, not yet.
No problem. I've got that. I'll get the PDF and then send through to you, so you can start working on those questions as well.
Thank you.
No worries. But otherwise, we'll carry on with the chapters next week, and so we'll carry on with more audit evidence, stroke systems and controls, and just we're doing well for time. So there is some. I'm not sure. There's some talk about when we go back. So we're waiting to hear. But I got an email today about there is a discussion. There are discussions in place about going back. So now it's just about safeguarding and processes in place to make sure students are safe. So I'll keep you in the loop as to what's going on with that. But definitely we're still online, at least for the next few weeks.
Can I ask a question?
Yes, of course.
So obviously with the Kaplan books, they're valid up until June 2020.
Yes.
There's going to be no changes to the syllabus.
Yes, you're right. Yes, because I think our audit books were till June 2020. Yes, I think so.
Yes, correct.
Yes. There'll be no change. Yes, you're right. There won't be any change. There won't be any change. No, so that's safe. We're safe there. The good thing is, yeah, the problem could have been tax, but because the tax books finished 31st of March, they were fine anyway, even with the shift. So but with audit we're fine, so there's no change. Cool, great stuff. So thank you. I see some sunshine, so have a good, I don't know, I'm still not quite sure. I'm still not sure if we, I trust me, I actually like Boris, but I'm still not sure whether we stay in, we go out. I'm still not sure about what we're supposed to do. So so whatever you do, stay safe. And I'll see you next Friday.
Thank you, William.
Thanks, William.
No worries. See you later.
Bye.
Cheers.
Bye.
Bye-bye.